We've got a lot to talk about here to kick off a week that ends with big employment data and following on the heels of Jackson Hole's message of a potential taper happening this year. Jeff Kleintop joins us to kick off the week as the Chief Global Investment Strategist at Charles Schwab. Jeff, good to have you here. You got your mind on COVID and the impact on the markets. Where do we start this discussion right now?
Yeah, this to me is the biggest driver of the markets this year. I know we talk about taper, we talk about a number of factors, but overall, COVID's been the big driver globally. Whenever the global case count declines, cyclicals lead. Whenever that global case count rises, we see a return to defenses. That's happened again and again and again this year. I think we're about to make a turn back to cyclicals. We saw the 7-day average in cases just start to roll back over. That should be expected. That's what I'm referring to here in this chart, that orange line starting to possibly roll back over again, what we would expect given the new restrictions that have been put in place. And if that's the case, look at those lines on the bottom. This is the difference between defensives and cyclicals. When those lines are going up, what we see is along with the case count, we see internet retailers outperforming airlines. We see growth stocks outperforming value. We see U.S. stocks outperforming international. But we're about to see the reverse now, I think, a rolling over of this, meaning cyclicals making a comeback. And maybe we saw just a little bit of that last week. I know it was all about energy given Hurricane Ida and OPEC+. I think there's a little bit more to that as we see more of the cyclical sectors start to lead.
Love this chart. We've talked about things related and similar to this, and it holds so well still over time. Jeff, do you think that right now we have clarity on how that orange line, the cases, will go? I mean, it seems like from the data I see that the U.S. hotspots that began this wave seem to be cooling. But to your point, the market's kind of already moved here the last month in trying to shift to that more cyclical trade. How do you think the two line up right now? Do they fit, or is one ahead or behind of the other?
Well, I think they're still pretty much in sync. And I think over the next several weeks, given what we're already seeing in terms of that case rollover in a number of hotspots, as you mentioned, and other hotspots around the world, which have been leading the U.S. case count lower, I think we're going to see that come down. And generally, they move in sync. Here's the challenge. As we get later into this year, maybe into the colder winter months, we know the virus season just comes back, and that could mean a return of COVID as well. So unfortunately, we're not leaving this pattern behind. A move to the downside here favoring cyclicals over the next several weeks, maybe months, could return to a shift back to defenses as the weather cools down again, unfortunately.
Okay, so Jeff, the other part of this that is, I think, interesting is right into our dollar conversation. As you point out here, the U.S. stocks outperform the world when we have this COVID fear overhanging and the COVID case counts climbing, as we saw one of those lines there showing the S&P outperforming the MSCI Euro. How does that work in with the dollar? How much of this dollar move to the upside since June do you think is about COVID, and how much is about the taper potential? Is it more mixed there, or should we expect if COVID starts to decline that the dollar starts to decline?
It's mixed, and so that's certainly an element. As we see COVID begin to decline, we should expect to see a little bit of a weaker dollar there as markets just get more bullish on a cyclical outlook and safe havens like the dollar fade. But we do have to keep a close eye on the outlook for the taper. That, of course, makes the jobs report very important on Friday. What I'd say is it's a battle between when we see rate hikes and what we see in terms of U.S. inflation. Remember, it's not just U.S. short rates that matter, it's real short rates. And if we continue to see these inflation pressures in the U.S., we may not see real rates or expectations for real rates rise, even though expectations that the Fed may hike rates may pick up. Keep in mind that we are seeing a return of a number of inflation pressures, including supply chain bottlenecks, which had faded in May and into June, are now back at full steam. Port traffic is now completely congested again. We've got backups everywhere. We're seeing more and more companies mention renewed supply pressures, and we know that can have some impact on inflation. So if inflation is going up, even ahead of Fed expectations, real interest rates in the U.S. are headed lower, and that's a net dollar negative.
Now, Jeff, the interesting thing, too, is that right now the global economic data seems to be fairly in sync, where most of the economic surprise indexes here, elsewhere, they've all drifted lower. So at this moment, it's, the dollar kind of firmness seems interesting in that perspective. It's not like our data is beating everyone, right? So to your point here about kind of mixing in with some of the policy relative to inflation, what does it mean that we've gotten all these numbers missing? Is this sort of a global moment here where we could be in need of another boost of stimulus or something? I mean, is this all COVID attributable to, or is there maybe just kind of a global exhaustion of, risk sentiment or optimism? I mean, what do you make of this here as our data everywhere has been missing for about a month and a half?
I think it is COVID. I think if we take a look at some of the high frequency indicators that can give us some sense of what's happening on a real-time basis, things like TSA throughput has really leveled off at 2019 levels. So have open table restaurant reservations or even box office results in some of the key states and countries that have been hardest hit. So what we saw prior to that was good improving momentum. And that momentum since the middle of June has stalled out. It hasn't reversed, but it's stalled out. And that's been a little bit disappointing to economists and maybe investors as well who are looking for further improvement.
Okay. So, Jeff, when we look ahead to this week, U.S. is getting a big economic data print. If we do see that beat expectations, if we start to turn our surprise rate around, do you think that that is powerful information, even if our COVID curve is unresolved at this point? If we're able to improve the economy here at home, is that going to be sort of a potential for reversal in some of the stuff we're talking about here? Does that add into rotation potential? Does it maybe add into dollar strength if we get a big print on Friday?
Maybe it does. I mean, in some ways, it's a double negative because it's certainly great to see jobs improve. But if it brings the Fed forward at the same time we still have lingering COVID concerns, that double negative could weigh on the equity markets in favor of safe havens like the dollar. So that is a threat to this rotation to cyclicals that we've got to keep a close eye on this week.
One of the other things we're talking about this morning is the Hurricane Ida and how that affects supply chains. I'm looking at some of the data that you were exploring as well related to COVID. And I mean, when you look at just the global supply chain situation, it's stressed again already, right?
Yeah, it really is. This is something that we haven't seen. You really got to go back to the peak in February where supply chains were really damaged to see them like this. The number of ships at anchor in San Pedro Bay is back to where it was in February. We've seen a huge dive in the PMIs for supplier delivery times. That's what you're seeing now. This is companies indicating that it is taking now longer than ever for them to get shipments delivered. This is semiconductors and tires and so many things. That's a risk to sales, to production, and to inflation as we head into the all-important holiday shipping season. I want to say, last year, I think it was November 6th that Amazon sets as its deadline for when suppliers have to have things to Amazon, their distribution centers, for holiday sales, for Black Friday and into the holiday. Well, that means if you had 2 weeks of shipping time, plus now a month or so sitting at a port, we've got a real crush here in the next few weeks for businesses to try and get their supplies lined up, try and book container vessels, and those prices are likely to continue to climb. The ones we're watching there for container freight numbers from China to the U.S. going to continue to climb, and that's certainly not good news for corporate margins. So a lot of pressure right now, renewed pressure, something we haven't seen really since back in the first quarter.
It's pretty amazing the way we got to such extremes in many of these measures the last month here that only goes back to the worst periods of COVID. Yet a market that is trying to seemingly start to move past it with the signs of this rotation creeping in the last couple of weeks, as we saw in that first chart. Jeff, thanks for the perspective.